All right. So in our first lesson, we were talking about the basics of accounting, what actually accounting is. So we learned about that accounting is basically recording, analyzing, and reporting. So in recording, we record all the transactions, you know, that all the transactions which are happening. Let's say you paid the rent. Okay. So paying rent is a transaction, and in recording section, we are going to record the transaction. Okay. So we record all the transactions and then we analyze them in the form of financial statements. The two major financial statements we have are income statement. So income statement is concerned about whether business is making profit or whether business is making loss. And another financial statement we have is balance sheet. Okay. And then we report it. Report means we publish the financial statements. Okay. All right. Okay. Then we talked about the basic accounting concepts like accounting equation. So accounting equation is assets is equal to capital plus liabilities. Assets, anything which a business owns. Capital is investment by owners, right? And liabilities is anything business owe to someone else. Okay, let's talk about the examples of assets, capital, and liabilities. We talked about them earlier. So asset is basically, your stuff like property, plant, and equipment. Cash, inventory. Okay. And we also have receivables. Okay. Receivables are also our assets because, we are actually expecting cash from them. So they are going to pay us cash. So receivables are also our assets. Receivables are basically the credit customers, like, the someone that you did the sale and you asked them, you actually gave them a credit limit and a credit period, and they're going to pay you later. Okay. So these are your credit customers, right? So credit customer, you made the sale and they're going to pay you like after a while. You are expecting cash from them, so they are also considered your assets. Okay. All right. What else? Yeah, okay. So these are the examples of assets. Investment by owners, capital, we know that what it is. And liabilities, stuff like bank loan, payables, eh, overdraft. So this is the stuff we talked about in our first lesson. Now we are going to use same counting equation to learn about debit and credit. So first, let's see that what debit and credit is. We call it double entry bookkeeping. Okay. So we make an account like this. This side is debit and this side is credit. Okay. So, if you try to understand a logic behind that why something is being credited and why something is being debited, so you would not be able to find any logic behind it because, that's sort of one of the assumptions that every subject has. Like, like in physics, why 1 kg is equal to 1 kg, right? For that matter, why one is one and why two is two and why three is three, right? Why four is four. Why A is A. Why A sounds like A. Why it's not sounding like B. Okay. So ev to s- to have a start, every subject has got some basic assumptions, and debit and credit is like one of those assumptions of accounting. So don't try to find any logic behind it at this point. Probably we'll be able to talk about that later, and we can figure out that why we structure our accounts in debit and credit. So we can talk about that later. But at this point, that's going to be a more of a memorization thing. Okay. So when we are writing on this side of the T account, this is called a T account. When we are writing on this side of the T account, we call where this is being debited. Okay. And when we are writing on this side of the T account, this is being credited. Okay. Just keep that in your mind. Right. Okay. Using the accounting equation, assets is equal to capital plus liabilities. When asset increases, is they are debited. When asset decreases, they are credit. Okay. For capital and liability, it is opposite. When capital increases, is credit, and when liability increases, is credit as well. So it's opposite to the assets. Okay, and that makes sense as well because it is coming on the opposite side of the equation, right? So when capital increases, we credit. When capital decreases, we debit. In the same way, when liability decreases, we credit it. Okay. All right. Let's try to do some example. Okay, so look at it. So we have to see that what is happening to the assets and what is happening to the liabilities and what is happening to the capital um, as a result of these transactions. So our first transaction is bought office machinery on credit from D. Isaacs. Okay. Bought office machinery on credit from D. Isaacs. So when we bought the machinery, our machinery is increasing, and machinery is an asset. And in this case, our asset is increasing. So as asset increases, we debit it. It means account to be debited is going to be our machinery account. Okay. D. Isaacs, because we are buying it from D. Isaacs, so D. Isaacs is becoming our liability. And in this case, our liability is increasing. So when liability increases, we credit it. So D. Isaacs account would be credit. Okay. Okay, forget about this one. Let's do the next transaction C. So a debtor, our receivable, and Fox paid us in cash. So when he paid us in cash, it means our debtor is decreasing. A debtor is a receivable, okay, a credit customer. So our credit customer is paying us cash. When he's paying us cash, it means our asset is decreasing, right? Because when a credit customer is paying us, it means they are not going to be our asset anymore, right? It means our asset is decreasing. And as our asset is decreasing, we know that when asset account decreases, we credit it. Okay. So NFOX is our asset, and our asset is decreasing, so we credit it. Okay. NFOX account is credit, and because he's paying us in cash. When he's paying us cash, it means our cash is increasing, and our cash is an asset. So that asset is increasing. So cash account will be debit. Okay. Now look at this transaction. Repaid part of loan from D Exeter by check. Okay. So we took a loan from someone in past, and now we repaid the loan. When we repay the loan, obviously, we are paying it in cash, so our cash is decreasing. And when asset decreases, cash is an asset, and when that asset decreases, we credit it, right? So cash account is credit, and the Exeter, which was our liability, and in this case, our liability is decreasing. So when liability decreases, we debit it. Okay. I hope it makes sense. Okay. Returned sum of office machinery to D. Isaacs Limited. So when we return the machinery, machinery is an asset, asset is decreasing. So machinery account credit, and D. Isaacs was a liability. And when we return the machinery, it means we are not going to pay them anymore. So our liability is decreasing as well. When liability decreases, we debit it. So what was the name? D. Isaacs. So D. Isaacs is debit. Okay. A debtor, another credit customer, a debtor, which was our asset, and Len pays us by check. So because he's paying us by check, so our bank is increasing. Bank is an asset, right? So as bank is increasing, we debit bank and we credit and Len because as a credit customer, he was our debtor or our receivable, right? And debtor is an asset. So when he pays us, he's no more our asset anymore, right? So when it means that my asset is decreasing, and when my asset is decreasing, I'm going to credit it. Okay. Bought van by cash. Bought van by cash. Van is an asset which is increasing, so debit. Cash is an asset which is decreasing, so we credit. Okay. Okay. I hope you understand it. So if you have any question, you can actually ask me, right? This second question you are going to do as your homework. Okay. All right. Now, okay. So let me just give you a key recap again. So assets is equal to capital plus liabilities. When asset increases, we debit. When capital increases, we credit. When liability increases, we credit. Okay. Oh, okay. Let's have a look at these transactions from the perspective of assets, liabilities, and capital. So started business with 12,000 in cash. So, there is one more thing that we need to understand that business is a separate entity. An owner is a separate entity. We are accountants of business. We are not personal accountants of owner, right? So we would be looking at the things from the perspective of business, right? So when owner puts money in business, we are looking from the perspective of business. So cash is increasing. Okay? Cash is increasing, which means asset is increasing, and we are going to debit our cash account. And another thing which is happening is capital. So capital is also increasing. When someone puts money in business, from the perspective of business, capital is increasing, like owner's investment is increasing, right? So this first transaction is started business with 12,000 in cash. Started business with 12,000 in cash. So my asset is increasing, because my cash is increasing. So I debit cash and I credit capital. Okay. Debit cash, credit capital. This is my first transaction. Second transaction. Paid 11,700 of the opening cash into a bank account for the business. So we put the money in the bank. We had some cash and we had the cash in the till of the business. So we took out that cash and we put into the bank. So our cash is decreasing and our bank is increasing. Okay. So cash bank account would be debit and cash account would be credit. Okay. Because both of them are assets. Okay. So bank account debit and let me write it like this. Debit bank, credit cash. Okay. Right. Next transaction. Bought office furniture on credit from Dream Limited. So office furniture is our asset and that is increasing. So debit, furniture, and credit, because in this case, we are buying it from Dream Limited and we are buying on credit. On credit means we are going to pay them later. So they are becoming a liability. Okay. So liability is increasing. Debit furniture, credit, Dream Limited. Okay. Next transaction, bought van, paying by check. So bought a van paying by check, our asset is increasing. So we debit van and we credit bank because we're paying through bank and my bank is decreasing, right? Next transaction, bought equipment from Pierce and Sons on credit. Equipment is our asset, which is increasing. So debit equipment. And what is happening? Because we bought it from Pierce and Sons, so that's a liability. Our liability is increasing, so we credit Pierce and Sons. Okay. Okay. All right. So return faulty office furniture costing 120 to Dream Limited. So we returned it. So our office furniture is decreasing. So our asset would be credit, office furniture, and we debit um, Dream Limited because Dream Limited is my liability and liability is decreasing in this case. Okay. So when liability decreases, we debit. When liability increases, we credit. Okay. Sold some of the equipment for 200 cash. So equipment is decreasing and that's an asset. So equipment is credit and because we sold it and we're getting the cash. So cash is increasing and that would be debit. Okay. Paid amount owing to Dream Limited, 1780 by check. So we paid the person. He was a liability, and then we paid them, so they are no more a liability. Okay. So the liability is decreasing. We debit the liability. Liability is okay. Dream Limited. Okay. Debit liability because liability is decreasing and credit paid amount owing credit bank because bank is decrease. Okay. Right. Took 130 out of the bank and added to the cash. Debit cash and cash credit. Debit cash. Oh, sorry. Yeah, debit cash and credit back. Because the asset of cash is increasing and asset of bank is decreasing. F. Brown lent us 4,000, giving us the money by check. So F. Brown gave us some amount. F. Brown is a good person. So because he's paying us through bank, so bank would be debit and F. Brown credit. Oh, F. Brown is a liability. Okay. So yeah, this is how it's working. Um, so that's how we do the debit and credit. Let's quickly, let me show you how we actually write these transactions. We're going to do the same question, and this time we are going to make journal. So we make the journal, and journal is like, you write the name of the account, and then you write the debit and you write the credit. Okay. So started business with cash 12,000. So debit cash 12,000, credit capital. Paid 11,700 of the opening cash into the bank account. So debit bank 11,700 and credit cash 11,700. Bought office furniture on credit from Dream Limited. Debit office furniture. And because Dream Limited is a liability, so liability is increasing. So we'll credit it. Okay. Bought a van, paying by check. Debit van, credit, check, because we paid by check. So credit bank, 5256. Bought equipment from Pearson Sons. Debit equipment, to 2,300. And credit Pearson Sons, same amount. Okay. So that's how we do the double entry. That's how, we record the double entries. And then, once you are comfortable with writing the double entry bookkeeping, we are going to talk about how we record how we actually make the T accounts. Okay. So This question is your homework. And there was another question. Yeah, this one, let me make it a little bigger. These two questions are your homework. Okay. Now, means we have 3 homeworks in total. Mm, okay. Now, this question and the later 2 questions. If you have any questions, any queries, you can talk to me. So this is the double entry bookkeeping for assets, liabilities, and capital. And in our next lesson, we are going to talk about the double entry bookkeeping for um, sales, purchases, sales returns, and purchase returns. Okay, right. Thank you very much. Send me your homework when you're done with your homework. Send it to me. Thank you. See ya.